I'm joining us right now to talk about the Fed's recent quarter-point rate cut, the central bank's future rate path, and much more. We want to bring in Jim Bullard. He is the former St. Louis Fed president who's now dean of the business school at Purdue University. He's also in the running as the next Fed chair. And as we heard from Treasury Secretary Scott Bessent last week, they had a very good and productive meeting recently. Jim, thanks for being here this morning. Good to see you. What did you think about what the Fed did last week? 25 basis points. Does that sound right to you?
I think it was right. It wasn't just 25 basis points. They put October in play and December. So if they follow through with that through the end of the year, that'll be 75 basis points. Most of that's priced in already today, so it's sort of as if they moved already. But it also gives them some optionality to watch the inflation numbers and the jobs numbers as they come in through the rest of the year. And they could pull back if they had to or delay a little bit if they had to. So, in the way that the committee works, this is kind of a natural decision to make for this situation.
We spoke with the Treasury Secretary last week. He said that he had a very good and productive meeting with you in terms of interviewing you to be the next Fed chair. Most of the people who have been in the running for that job have said that they would cut rates more and more quickly. Your answer is a little more nuanced in this position.
I've said we wanted to get 100 basis points by within the next year. So we've got 25 of that, and the time horizon has come forward. So now you could maybe get 100 basis points by the end of the first quarter. That would put you in neutral territory, and then we could argue about where neutral is. But you do have to watch the inflation side of this. Inflation's still in the high 2% range by preferred measures of the committee. So they want reassurance, I think, that inflation is going to continue to track down to 2%.
What do you think about inflation and the potential for it rising again? People had been waiting for the tariffs to kind of push prices higher. It hasn't really happened to this point. Do you think that is an issue? Do you think it's a one-off factor if it does happen?
Yeah, tariffs are a tax. That you have to look at the incidence of the tax. Probably a third of that would go to the foreign producer, a third of that along the supply chain, and a little bit toward the consumer at the end point. But, and also the consumption basket in the U.S., that the foreign good portion of that is relatively small. So you wouldn't really expect the overall inflation rate to be too much impacted by this. So I think that's what's coming out in the data, and I know there's been a lot of talk about it, but the U.S. Trade Representative doesn't have an inflation target. It's the Fed that controls the inflation rate over the medium term.
How much do you think the Fed has control over, though, what happens to the longer end of the curve, the yield curve? Because there's been so many questions about how much power the Fed actually has, particularly if you want to get at things like trying to bring down mortgage rates and trying to help boost the housing market at this point.
Well, the longer end of the market is very sensitive to how much confidence markets have in the medium and longer run policy of the Fed. So credibility is the name of the game. And if you want to keep longer rates low, you have to be reassuring people all the time that you're on the job, that you're going to keep inflation low and stable, not just in the near term, but in the medium and longer term. So that's really what can deliver lower long-term nominal interest rates. I would say also maintaining the reserve currency status of the dollar, that allows us to borrow internationally at lower rates than we otherwise would. So you want that to be part of the picture, too, to keep a lower level of rates as you go forward. If you lose some of that, then you get risk premiums priced into the longer yields, as you guys talk about all the time. And then we all have to pay higher interest rates all the time. So we don't want that.
Jim, that's really interesting. And again, it goes back to kind of the difference I see in what you've been saying and what many of the other people who have been interviewed to be the next Fed chairman have been saying, too. Many of them have their own reasons, perhaps, for why they're saying it, but their views reflect much more closely with the president's views. in terms of wanting to bring down interest rates very quickly. Are you worried that if that happens, if the next Fed chair lowers rates substantially, and it looks like it could be connected to political pressure coming from the president, that the Fed loses control of the long end at that point?
Yeah, I do worry about that. I've heard the president say that he would, if inflation is a problem, just raise interest rates again. But if you have a whipsaw kind of policy, then markets start to worry about that. They start to price in inflation risk premium at the longer end, and that's very hard to get rid of. So it's a careful game that you have to play, and you have to be systematic in policy and clear as clear as we can be about policy, and make sure that everyone's on board with the idea that we're going to keep inflation low and stable over the medium and longer run.
Stephen Myron, the most recent Fed appointee who just took the position last week and voted at the FOMC meeting, was speaking yesterday at the New York Economic Club and said that he plans to dissent with every one of the votes that continue to come up. I guess that's based on the assumption that the Fed is not going to cut rates as quickly as he or the president would like. Do you think that's the right move? Is the Fed moving in the right direction as far as you're concerned?
Well, he made a good speech yesterday, and he certainly makes interesting arguments about a lower neutral rate. And he could certainly vote as he wishes on the committee and make his case. He's a good economist, so a lot of good arguments in there. I think the committee thinks that the neutral rate for the federal funds rate is about 3 or 3 1/4, somewhere in there. He thinks it's maybe 100 basis points lower than that. That would give the committee more room to maneuver. There's no doubt about it. There's a big confidence bound around the neutral rate. I guess one question I would have for what he said was, if we're as restrictive as what he's saying, why hasn't inflation come down more sharply and more quickly? That's one thing I would have an eye on about with respect to that argument. And also, I think the president's policies and the Republican policies here, I think, are ultimately going to be successful. I think there's going to be a reacceleration in growth, maybe starting now, but certainly in 2026. And so you have to be looking ahead and seeing that reacceleration coming. Usually that adds a little bit to inflation pressure, and so you got to take that into account. If you felt like there was recession was just around the corner, then maybe you go down very quickly. But that doesn't seem to be what Wall Street is thinking, and it's not what I'm thinking about what's going to happen in the economy over the next year or so.